It's time to introduce the second panel of the day. It's very much related to the industrial point of view in the financial transition. And I hand over to the moderator of the next session, who is my colleague Nick Appleyard, Head of Business Application Department in ESA. Nick, welcome, and the floor is yours.
So thank you, Donatella, and welcome back, everybody. Welcome to the audience who are continuing from our first session, which has been very interesting, very stimulating for me. So I'll introduce myself first. I'll be the moderator for this second session, lasting for the next 90 minutes, where we have 8 speakers. I'm Nick Appleyard. I head the Space Solutions Department at European Space Agency, and I'm talking to you from the headquarters in Paris today. Although my normal business office is in the UK, where we run many of our business-facing opportunities from. So I'm responsible for bringing the technical capabilities of space towards the commercial markets. So when we look for a market, we look for one which contains multiple customers who may pay for a service, for a product. So if you do not have customers, then you may be doing great things, but you're not a business. And what we're concerned with our programs is really with businesses. And we want businesses also which have a positive impact. And we heard at the beginning of today from our Director General, Joseph Aschbacher, about the importance of sustainability, about the importance of climate impacts in what space can offer, and also its role in digital transformation, digitalization of the economy, and how all of these things come together through the power of commercialization, which is a current priority for European Space Agency. So once we've found customers, then ESA will work with them in order to help develop the products and the services which serve their needs, and we work with the industry who will offer those to that market. And also we will help to develop the companies themselves so they have sufficient scale and resilience to be able to offer those products into the market and to take them worldwide. And in order to do that, those companies require investment, and they require a source of finance. And we want that finance source to be sustainable. We want it to be available in Europe. Sustainable in the sense that it is investing towards these objectives of sustainability, but also sustainable in the sense that the finance itself can be relied upon into the future, because many of the things we're investing in have a long time horizon. So that's a little context from the ESA perspective, but really I want to give the maximum time today to our guest speakers, because really we have some excellent panelists to present to you over the next 90 minutes. And really we're going to cover the whole alphabet from IMF to EIB. And along the way, we will talk about risk, we will talk about banking, we will talk about fintech, we will talk about the role of data in achieving sustainability objectives. So I hope you stay with us for all of that time, because it's going to be an excellent ride. These speakers are joining us from across 4 countries. This is something that we can do in 2021, which we're very grateful for the power of connectivity technology. So let me first then introduce the first of our speakers, who is Dr. Fabio Nattalucci, who's the Deputy Director of Monetary and Capital Markets at the IMF. So he is responsible for the global financial markets monitoring and systemic risk assessment functions, and for the global financial stability report that gives the IMF's assessment of risks to global financial stability. Prior to the IMF, Fabio was in the Federal Reserve Board, where he was a Senior Associate Director in the Division of Monetary Affairs. And they're doing research and current analysis on the relationship between monetary policy, financial regulatory policy, financial stability again. And prior to that, he also served in the US Department of Treasury as a Deputy Assistant Secretary for International Financial Stability. Fabio holds a PhD in economics from New York University. And so, Fabio, if I can ask you to share your presentation with us, and maybe you open this panel with an overview on the role of climate-related data in this agenda that financial stability and future resilience. So thank you. I hand over to Fabio. Fabio, we do not hear you.
Can you see it?
Yes, yes, the screen share is working now. Perfect, thank you.
Okay, so the urgency in terms of addressing climate-related risk is something that it's well understood, and it's been widely seen as an imperative. Now, the IMF has done quite a bit of work on climate risk and opportunities. There are one issue that we've been highlighting, which is the information challenges. There are major information challenges in terms of assessing and pricing financial risk, both from a physical as well as from a transition risk perspective. For example, implementing carbon pricing globally would probably be the most effective policy, but there are implementation challenges, and so a policy mix, including green investment push, may be warranted. On that perspective, sustainable finance can play a role through stewardship by lowering the cost of capital. Again, the issue here that there are major information challenges that need to be overcome to foster a sustainable finance market. Now, one issue here has to do with bridging the data gap. In particular, there are important issues as they relate to the quality, comparability, as well as consistency of granular climate-related information. Now, to overcome some of these information challenges, in particular, allow for effective assessment and management of climate risk and opportunities, there is an important need to strengthen the information, what we call the information architecture around such risk. In particular, we look at information architecture, climate information architecture, around 3 building blocks. One is high quality, reliable, comparable data. The second part is in terms of harmonized, consistent set of climate disclosure standards, then broadly agreed upon global taxonomy. So let me jump into the 3 blocks. And the first block is what I'm showing here, the issue of high quality, reliable, comparable data. Now, bridging the climate-related data, it's an important issue, as I mentioned, but there are, as I said, challenges as they relate to reliability, comparability, and availability of data. In particular, we ran a workshop during the spring IMF meeting back in April with participants both from the private sector, so banks, for example, asset manager, corporates, as well as from the public sector. And I think I'm going to highlight a few data challenges that we have faced in terms of bridging the data gap. The first one has to do with the lack of granular, verifiable, forward-looking data, particularly in terms of firms' effort to transition to a sustainable business model. These data gaps are particularly relevant for SMEs in terms of identifying the data needs and reporting, as well as for firms in emerging markets. There are high costs in terms of disclosure and third-party verification. Those may reduce the incentive to issue ESG-friendly securities. There's also insufficient clarity in terms of what is required by the stakeholder, in terms of data, in terms of disclosure. And importantly, data needs to be decision useful. That's an important point that has been raised by many during the workshop we held. Now, of course, it remains difficult to determine the impact of investment on non-financial objectives. This is what people discuss in terms of risk of greenwashing. So metrics can actually help asset management investment decision, but there are model uncertainty around scenario analysis, for example, and also the lack of comparability. And the risk here to create, in some sense, a false sense of precision. And then another issue that's to do with data is verification and auditability of data that would improve the comparability. Now, the second building block of this climate information architecture is to do with the need for an harmonized and consistent set of climate disclosure standards. Non-financial disclosure or sustainability disclosure as they relate to climate risk and opportunities, compared to the level rigor of financial reporting, they are still in its infancy. There's a fragmented space out there in terms of climate disclosure. There are multiple frameworks that are being used. That, in some sense, become an issue because it can hinder, first of all, consistency across this framework and also comparability from an investor standpoint. So there is clearly a need for convergence to an harmonized and consistent set of disclosure. As an example here, looking at the TCFD recommendation, looking particularly at one of the pillars, so metrics and targets, that reporting has improved, but the share of firms reporting remain low, as you can see here in the chart to the right, especially for smaller firms, because the cost of disclosure can be substantial, again, particularly for SMEs, and as I said before, challenges also for emerging market countries. The third piece of the climate information architecture has to do with the need for a broadly agreed upon global taxonomy. Taxonomy is essentially a way of sharing common language, right? So it's an important component as we think of the chain of information from borrowers, whether those are firms of household, lenders, so banks, as well as non-bank financial institutions, as well as investors. So taxonomy can play an important role here in terms of fostering sustainable financial markets, making sure that the investor understands the data and is speaking a common language, not only within a single jurisdiction, but also across jurisdiction. Now, of the three elements, again, data, standards, and taxonomy probably remain the least developed element of this architecture, and there is a need for a well-designed, globally agreed upon taxonomy to lower transaction costs, particularly costs related to third-party verification and the risk of greenwashing that I mentioned before. Now, one of the challenges with taxonomies is because if they focus excessively on fully sustainable investment, may fail to recognize the transition effort by firms and countries. And again, this is particularly relevant for emerging market economies, where in some sense, in the color spectrum of the taxonomy, in between green and brown, there's a lot of greenish and brownish. And so how to set up a taxonomy that can incentivize essentially the transition toward the green part of the color spectrum. Now, again, as I already mentioned, this is particularly problematic for emerging markets where investment for transition purposes are needed the most compared to advanced economies. Now, what is the way forward? And I'm going to break the way forward in three pieces: one for data, taxonomies, and standard. In terms of data, the IMF strongly support the work done by the Bridging the Data Gaps workstream at the NGFS, a network for greening the financial system. I co-chair the workstream with Patrick Amis at the ECB, and this focus of this workstream is to produce a list of data items that are currently missing and come up with recommendation how to close the data gap. So we identify essentially data needs, data availability, where the data gaps are, and how to close this gap in terms of policy. And this is a very much a user-centric approach, thinking about what are the needs for what and how to address those needs. The IMF has also set up a climate change indicator dashboard aimed at addressing the growing needs for data in terms of macroeconomic and financial policy analysis that is publicly available. And importantly, also technical solution can be part of the answer here, thinking about artificial intelligence or open source, both in terms of a data collection approach as well as software, but also for distribution and making data analytics available at scale, so building on the scale. And then finally, in terms of the way forward for data, there is also a need to develop information system on climate data, metrics, analytics. And this is particularly important on the side of reporting firms. In terms of disclosure, as I said, there is an urgent need to attain convergence in terms of sustainability reporting standard. The fund strongly supports the IFRS Foundation initiative to develop global sustainability reporting standard with the support of IOSCO and building on existing frameworks and initiatives, such as the TCFD recommendation, as well as the efforts by the Alliance of Leading Standard Setters on Sustainability. We're working on this called prototype. In terms of disclosure frameworks, I think it's important to identify and build on decision useful information that span three key objectives here. One is the accurate market pricing and risk assessment of climate risk. This is important both from financial institution standpoint as well as from the investor standpoint. Second objective is financial stability monitoring and the risks that arise from climate risk, both in terms of physical transition risk. Then finally, encouraging the transition so fostering climate sustainable finance with the objective of encouraging the transition to a climate sustainable business model. And then again, the NGFS Bridging Data Gap workstream is exactly focusing on this objective. In terms of taxonomy and way forward, as I said, there's a need for a minimum agreed upon global taxonomy that is based on high quality, reliable data, and that because it would enhance not only the quality side of the data, but also enhance the effectiveness and quality of the disclosure themselves, which is what investors are asking. Now, of the three pieces of this architecture, this is probably the least developed part. And although there have been efforts by the European Union, for example, and other jurisdictions that are notable, but there's again here a need for convergence on a global scale on some minimum taxonomy. Now, as I said before, taxonomy need to be flexible enough to encourage transition effort, to recognize, incentivize transition effort. Recognize, for example, differences between advanced economies, emerging markets, and large firms and SMEs. And so let me close the presentation with perhaps what are the challenges that remain. Now, I would note that momentum has been building over the last 6 months at a quite fast pace, but there are still some challenges, right? So one is the need to recognition that a clear pathway toward consistent, timely, uniform implementation of international agreed climate disclosure is something that is necessary. And this is where we see building momentum going to COP26 in November. Second challenge is that there is a need for a substantial international commitment. At the same time, we also need to be cognizant of regional, institutional, legal specificities and sensitivities. To make real progress, there are also important implementation issues that need to be addressed. Materiality, for example, single, double, dynamic materiality, voluntary versus mandatory standard, and so on. And then finally, this is a climate approach first. Everything I said so far relates specifically to climate. At some point, and this is what the priority is now, and it's probably appropriate, at some point, broader sustainability dimension, loss of biodiversity as an example, also will need to be eventually considered. And I will stop here.
Many thanks. So thanks, Fabio, for that. And we move along quickly, I think. We'll take questions at the end. So I encourage everybody to use the chat to submit their questions, and the team will moderate them for a Q&A session. Our next speaker then in the schedule is Dr. Philippe Aby. And he is the co-founder and the chief executive of RepRisk, the company, data science company based in Zurich. He also serves on the board of the Swiss Sustainable Finance, which aims to promote sustainability in the Swiss financial market. So we touched some of the same themes here. Before RepRisk, Philippe worked in the biopharmaceutical sector with Amgen, and also took on various international assignments with Boston Consulting Group. So he has this research background in economic analysis to draw upon. Also, so Philippe, to introduce your presentation, may I ask you quite an open and general question about how does ESG data science, remote sensing, georeference data, how are they impacting investments?
Good morning, everyone. Thank you very much, Nick, for the introduction. And I love that question, and that's actually exactly what I tried to answer with the few slides that I brought with me. I hope you see the screen now. All right. So, as Nick said, we are an ESG data science company. So what does it mean? I mean, ESG, this stands for environmental social governance, and that's a term that has not been coined back in 2006 when we started. We just talked back in the days of environmental social governance risks. And what we basically do is we collect all sorts of information regarding ESG with several technologies, and serve that, and this is now the part regarding sustainable finance, to distinct client groups. The most prominent always used to be the banks that use our data for due diligence with respect to client relationships. but also with respect to specific transactions in lending or regarding an IPO or regarding some project finance and trade finance, maybe related to a gold mine somewhere in Argentina. But now this ESG is a huge thing now all of a sudden on the investment side as well. This has become our biggest client segment, and it's also quite common nowadays to use this ESG risk data, the due diligence part regarding supplier screening. What I mentioned some other client segments. What I have not mentioned here are insurances. We also are very honored to serve a lot of insurance companies. We don't yet have the penetration as we have for banks, and that's one of the reasons actually that we thought, okay, what else can we add to our data? This is then this georeference data and the remote sensing data. But first, let me quickly explain really regarding the question of Nick. So how does this all fit together? There's one part of ESG, environmental social governance, which is about issues and risks. So E, environmental pollution, waste, climate change, of course, that we discussed extensively, but also the social part that traditionally has been less looked at, but has become much more important now, also because of the pandemic. So think of labor issue, human rights, abuses, discrimination, and then of course the whole governance, corruption, bribery, fraud. The governance part definitely not something you can do with remote sensing, as far as I can see. But all of that is important because it's a compliance risk, ethical risk. If you think, for example, of the Norwegian pension fund that says we don't want to invest in a company that is associated with forced labor, it's a reputation risk, which was a reason why we called a rep risk, and of course it's a financial risk and in a particular an investment risk. So what we basically do or have done for the last 15 years, as I said already, we also always looked at the ESG through this risk lens, and we have taken out the in perspective. So we completely ignore what companies do in terms of self-disclosure and reporting, because we believe in it's about material risk. It's sometimes even impossible for companies to report on something like corruption, as I said before, or child labor. And what we do is basically we leverage machine learning because we have, I don't know, maybe a thousand years of analyst time that we spend basically in actually checking in incoming data and labeling them, annotating them, tagging them, so that we can do machine learning. I explain that in a second. However, this is on machine learning regarding texts, sentiment, not regarding remote sensing data. And then we have this daily updated, that's quite important because it's pretty unique, daily updated research and metrics with unchanged methodology since January 2007. The one thing I want to focus on today is not on all the companies that we cover. We have more than 165,000 companies in our database that are related to one of these ESG risks. But I want to focus on infrastructure projects, because here's basically where the georeferencing data and the remote sensing data come in. But quickly going back to the current technologies, so what we currently do is we take any sort of documents that can be from non-government organizations, that can be from governmental agencies, that can be from the press, from blogs, social media, etc., and then basically try to extract what matters in terms of this ESG risk and whether such a risk is related to such a project I mentioned before, or such a company. And pretty much like in remote sensing, we depend on the, let's say, a ground truth. So basically, if something is said to be associated with a certain company, let's say regarding, I don't know, modern slavery, then basically we need the analyst basically then to see whether the machine has actually done the correct job to do this assignment, so that we can then always enhance basically this training data set that we have for machine learning. So this is what we have done, as I said, for the last 15 years, and now we step further in this process and bring in a completely new set of data. And in the first step, and that's actually not remote sensing, that's georeference data, and that's what I'm going to show you today, because that's the first thing we launch. We do something like a proximity analysis. So we talked about these projects before. This can be a it can be a dam, can be a coal-fired power plant, can be a road, a bridge, a factory. So the first thing we do is basically see, is this, let's say this gold mine, is that located somewhere close to a protected area, otherwise an area of high conservation value, to basically give additional information, due diligence information to our clients. As I said, banks, in investors, also a lot on private equity side, infrastructure investors, but also, of course, very interesting for insurance companies. It's about underwriting certain risks in emerging markets, frontier markets, etc. So the first thing we have to do is basically, and this is completed, that we match all these 40,000 projects we have in the database with the corresponding coordinates, and then basically see, thanks to our data partnerships with IBAT, for example, whether there's actually a protected area that is close by. The second step is then plugging in additional data, and this is where the real remote sensing comes in. For example, if you have point emissions from methane, if you have maybe land usage patterns that change, they basically see that you have a certain I don't know, palm oil plantation that actually eats into a primary rainforest. But the first thing I show you today is about the spatial analytics regarding geospatial data, and here again on the right hand side, very simple. So we have all these projects starting with mining, oil and gas, and we want to see, is that close to environmental sensitive site. So this is one step further, illustrative here for Colombia. Let's say you have some oil and gas mining projects, project A and B, and you want to see where are they close to anything sensitive which needs to be protected. But then also in additional information we provide to also, especially to investors, clients, is actually what companies are either operating these sites, these projects, or owning or partly owning these projects. And the way that actually looks, this is now a screenshot from our platform that we call the ESG risk platform. You see on top of it, just illustrative, you see mining company, in this case, a Brazilian mining company, Vale, that has a certain exposure with respect to this ESG risk. And then you have the additional information down there with 5 major mining developments and mining projects they have, and you see that some of them actually are in overlapping or in close or very close or close spatial relationship to some of the protected area, here referring to these 3 data sets from UNESCO World Heritage Sites, then the IUCN data and the Alliance for Zero Extinction site as proximity data. So this is basically how we want to bring together the sentiment data we have worked on for the last 15 years with the sensing data via the matching entity of the projects. So that's my introduction. Thank you very much.
Thank you very much, Philippe. And I think we certainly see many opportunities for machine learning and these data management technologies as we deal with the petabytes of data which come through the satellites now, and the rich resource that we have there. And really, we need the technologies to interpret this as an essential intermediary step. You talked a lot about risk, and that's a great introduction. Now for us to move on to our next speaker, who is Guillermo González from SCOR, the insurance underwriters, speaking to us from Zurich. And the motto of SCOR is the art and science of risk. So I think we connect very well here. Guillermo's works as an underwriter for the agricultural reinsurance sector, and looks at the markets in Latin America, North Africa, Spain, Portugal, and is also responsible for the aquaculture business. And before joining that reinsurance industry, he was working in Agroseguro, which is the company in charge of agricultural insurance in Spain, working in consultancy and international relations, advising companies in how to develop agricultural insurance products, so primary insurance. So Guillermo, if I may ask you to introduce your presentation, just please tell us about the role of the reinsurance industry in the agricultural sector. Guillermo, we don't hear you.
Now, okay, great.
Yes,
now it's
no.
working. Okay, I was saying thank you so much for the introduction. And answering to your first question, I may say that the agricultural reinsurance is a very challenging and very exciting work. As you were mentioning, I have been working for more than 15 years in the agricultural and insurance and reinsurance industry. And today, I will focus my presentation in the perspective of risk transfer from the agricultural reinsurance point of view. That is what I have been doing in all these years. Since I began to work, I have been observing how the space-enabled technologies have been gaining interest in my field of expertise. So I really appreciate that your invitation allows us to share our know-how in this part. Agriculture, as you all are aware of it, we are facing a lot of risk. We have weather risk. We see with the increased uncertainty due to the climate change that we have more extreme events of drought, flood, even frost. We have been suffering in Europe, in south of Europe now, late spring frost affecting a lot of crops. We see a lot of risk coming from epidemics, nothing to say more about this in our context. And as well, we have the market risk in which when there is a conflict between countries, there could be a disruption between the supply and demand, price volatility, and even some trade agreements could be interrupted and change the whole product chain of the farmers. Some of the risk are manageable at the farm level, in situ, we say. And for this, already the satellite technology is helping a lot. I mean, we all know the use of precise farming, and this precise farming helps to make a better use of inputs of the farmers to reduce cost. And I mean, when I was studying my degree in engineering, I remember that they told me that the first GPS was used in the tractors. So yeah, obviously technology is really helping us. But there are some other risks that are not controllable at the farm level. Why? Because the systemic risk. If we talk about a drought affecting whole Spain or whole south of Spain, it has a cat component that is not manageable at the farm level, so it has to be transferred to the insurance industry. And something that is very important, it requires the involvement of the governments. Altogether, we have to say that as well, there are some emerging risks that sometimes you may not consider, like cyber risk, and it's precisely because we are using in agriculture more and more technology. So these cyber risks become a concern as well for us. How, in this context, how we manage these existing and emerging risks from insurance perspective? We need to invest a lot into sophisticated farm practices and technologies. With which purpose? Because we need to define, assess properly the risk. We need to bring data. We need to create models to price the risk. And this it has been explained this morning in several conferences. The data are not available in a lot of contexts, especially for agriculture. For each season of crops, you have one data point. So the work that you, or the patience that it requires to build a proper database is very big. And then with all this, we need to design products and solutions that prevent, mitigate, transfer the risk, but they need to be accepted and understood by the farmers. And this is quite challenging sometimes. In my, here, sorry. Today, agriculture reinsurance has already a direct impact on farmers in many markets, and this is answering a little bit your previous question. Our role, that is mainly secure and stabilize the farmer's income, is strongly supported by technology, and we work very closely with this technology. Why? To prevent, to prepare, and to protect. And this requires understanding of the potential of technology. And understanding means understanding as well the limitations and as well how to make it accessible to the farmers. Sometimes we see that there are a lot of tools and we like to evaluate all of them, but this phase to analyze which one is the proper one for a specific transaction takes a lot of time and a lot of energy, and it's a key point, we think. What, from the reinsurance point of view, are the requirements to develop new solutions, new products? We need to understand the risks. For this, we need to understand what are the main problems that farmers are confronting. This is lack of excessive rain, temperature, heat freeze, drought, in case of livestock, lack of fodder, adverse weather, diseases. And this is very challenging because we can understand the risk, but if we don't have enough data to analyze it properly, or these data are there but they're not reliable, you cannot trust them, or they are subject to data protection that we see in some countries, is a big issue. And then we need as well to be able to create something to take an outcome out of this data. So we need to work with big data volume. Again, the technology is helping us in this point. Another challenge is that we need that the distribution of the product, the operational point, has to be feasible and manageable. And we need to talk about the distribution of policies, underwriting, and the loss adjustment infrastructure. And finally, a point that is not a minor thing, because all of us, we have insurance and we know what does it mean. We need to make them affordable. So how can we make use of the technology? We see a lot of technology helping us. We have computing power, satellites, crop modeling, fertilizer. For us, the key part is to use them properly, as I say, and I want to insist this in this part a lot in my presentation, because I think it's a key message that we are already having access to a lot of technology, but the problem comes when we want to make it feasible to be used and understand for the final users. Here, just to give a good example that SCORE has brought to reality in the recent weeks, I want to show an example of the use of technology in which several companies, ERB, SCORE, ESOR, have joined forces and combined their expertise with Airbus to enable Brazilian farmers to benefit from a satellite-based pasture insurance tool. Based on Airbus Grassland Production Index, the tool combines cutting-edge remote sensing technology with weather data to regularly monitor production areas, thereby providing a reliable and objective, this is very important, estimate of production. The losses caused by climate events such as drought will be covered. And yeah, at the end of the day, these kind of solutions are designed to mitigate the vulnerability of the farmers. But why we choose satellite technology to develop this product? Because traditional solutions were not suitable for pasture. Pasture is a constant production, you have a livestock, so you really need a follow-up on the grassland. So we didn't have a solution with the traditional tools, so we need to look for something specific here. Then it's adaptable to customer needs, and we have data. We have 15 years of data. And at the end, it's a multi-peril approach that is the best or one of the best solutions that we can provide to a farmer. But what are the challenges? And there are a lot. When you try to develop this, you have to make understandable this technology to brokers that sell these policies, to the insurance companies to understand why, to create the infrastructure inside the companies, and at the end of the day, to make it be understood and accepted by the farmers that are the owners of the tools that we are preparing at the end of the day. And this is really a long way to work on it. I mean, I think in this aspect of making the technology more easy to be understood and more accessible to the final producer, to the final user, is still a challenge. But I think it's very positive that we can show you today this kind of products that we are developing. It's a clear proof that reinsurance goes in this direction where we think it's feasible and is appropriate. My final slide is about if it is index insurance the solution, the right solution to be used in the markets or for some products. Here, I would like to say first that satellite technology for us is not only to create index insurances, we can use as well to control our portfolios, to control our exposure, and as well we are already working with some insurance companies in which they use the satellite images or other technologies to better assess the loss adjustment procedure. So the loss adjustment traditional and with cutting experiments, crop cutting experiments, they are more precise and more reliable as well. But making this apart, if we want to develop index insurance solution, what is our view on this? Our view on this is index insurance solution is a tool, and it's a very good tool that we like to use. But as other tools, I have a colleague, Aridus, that comes from Airbus, and is working in our team, that he always makes this example. He says, technology is like a hammer. You can use the hammer to put a nail on the wall, but you cannot use to amend a screen because you will destroy it. So for us, index insurance is a practical solution, but we need to not oversell it, to use it in the appropriate context for the appropriate crops, and trying to reduce at a minimum level the basis risk. For this, I think it needs a lot of education as well and a lot of patience, because sometimes we see ideas of developing something very fast, like in 3 months they want to have a solution, and this doesn't work. This needs a lot of time, patience, and learning how to do it properly. Of course, these kind of insurances have a lot of advantages. They are very cost efficient, they are normally faster implemented than traditional insurance, and they provide an independent source for index. There are no conflict of interest. So this is something very important. Finally, as a summary, I will just would like to reinforce that, as the logo of my company says, we like science and we are really looking forward to know more about satellite solutions, to receive more people processing images and offering products, because it's a way that is not going backwards. This will be the way that we will need to continue in the future, altogether with other measures. That's all from my side.
Very many thanks, Guillermo. And as you say, there's no one tool, technology, service which is a complete solution to all of the problems of the world here. We are really talking about assembling systems here out of many contributions. I think that is quite a good introduction to now when we think about the wider economic analysis of what happens as we move on to our next speaker, Professor Alexis Colombe. Now, Alexis is the Professor of Finance and also the Director of the Department for Economy, Finance, Assurance et Banque which I think those words translate quite simply into English: economy, finance, insurance, banking. I've particularly been interested to take a look at Elix's research work relating financial regulation to blockchain and seeing how those two agendas connect to one another. So he's the professor at the Conservatoire National des Arts et Métiers, CNAM, in Paris, really looking at this whole area of finance and financial regulation. He has a background as a practitioner in derivatives and cross-asset strategy, and quite generally across innovation financing. So Alexis, if you could start to give us some of the bigger picture, connecting the dots between space and the interests of ESA, finance, and the interests of society. How do we connect all of these things together and think about innovation in that space? I pass to you.
Yeah, sure. Thank you very much, Nick. Can you hear me well?
Yes.
Okay. So I think, first of all, thank you very much for having me. I'm very happy to be here with a set of such distinguished speakers and on this, particular topic. So there's a lot of things have been already said. I think, some of the main points that we've been circling around since the beginning of this morning. I think the first thing is this, essentially there's going to be 3 takeaway points. Can you see my presentation fine? By the way?
Not yet. It's not fully loaded.
Not yet. Okay.
Here it comes. Okay, now it's good.
Now it's good?
Yeah.
Okay. So the first main idea is that obviously, and this is outside of space for finance, but if you look at the space R&D, there's been a lot of contributions for, so-called terrestrial innovation and products, and, in various industries. I mean, here there are a few examples, one for spacesuit research that led to particular undergarments, another one especially in the field of software, formal verification and validation, the implications on whether the airline industry or the car industry, or also for safety procedures on, food safety, that, some of it was influenced from space habits, I would say. So when it comes to finance, and when you invited me to join this workshop, I first thought, well, okay, space for finance, there's 2 angles to look at it. There's one, obviously, what can space do for finance, and what kind of, and it's been greatly discussed, until now, the use of satellite imagery and telecommunications and so forth, and how we can leverage that for various applications. In particular, when thinking about finance in general, I think there's like essentially 3 areas. In the credit process, credit allocation, in payments, the second point, and then obviously in the insurance process. The third part has been very well addressed, I think, by Guillermo and the SCORE folks, and I'm not going to dwell upon that. When you look at credit and payment, there's obviously a lot of work that's been done, and in particular when focused on countries with underdeveloped banking systems, and clearly satellite techniques have been satellite access to the extent that it provides great and new coverage to specific areas of the world where there's no banking infrastructure, has been really key in financial inclusion. And that is really linked, I think, to the second point is the payment process. If we look at the African continent, as you know, a lot of payments are now still done through various telephone networks, And so obviously leveraging satellite access to have telecommunications, to be able to reach out to more people, to be able to give them the opportunity to pay in using telecom needs is a way of granting them financial inclusion, obviously. So there's just two quick use cases that I wanted to mention here very quickly, because some other people will do it, I think, or other participants in this panel will mention them in some way or another, I'm sure. The first one was the application, the so-called Space Chain, which is a great startup, which has some very famous and household names, blockchain community, someone like Jeff Garzik and others. But you see there, to the extent that as I believe that blockchain is becoming an increasing component of the payment industry, or is likely to become an increasing component in the future, the use of having something like a space chain. And as some of you probably, or all of you know, blockchain is about decentralization and preventing particular censorship. Well, the idea of having your nodes and delocalized in space, and having a very resilient and robust infrastructure is something that is particularly appealing. Here, just put here to mention the space chain Callisto, which is their latest programmable hardware. By the way, I have absolutely no links with them, but I thought it was, a very interesting application and use case to mention. Another one, when you think about using, satellite data and communications for finance, there's been a lot of discussion for increasing communication speed, and obviously the impact it could have on high frequency trading. So there are various ongoing initiatives. I just mentioned here there was a fairly example actually of the Wall Street Journal on the topic. This, I would say, is the traditional space for finance application that people would have in mind over the last the last 20 years, and it's all about speed. But by the way, as a interesting anecdote, the first time I heard myself as a finance professor mentioning using satellite technology for finance, it's essentially a hedge fund that was using satellite imagery. That was like already 15 years ago, for assessing the traffic on the parking lots of a major US retailer, and thus building their own traffic index to better anticipate the results, the quarterly results of that retailer. So, this sort of applications, I think, are, not particularly appealing to the general public, but and this is the point I want to make. I think that's what's particularly interesting now is the convergence between space and space technology and sustainable finance. In particular, it's been mentioned already many times this morning, for achieving sustainable development goals. And this is really what I call connecting the dots. I mean, there's a unique convergence now between the broader availability of space technology, the fact that we on a global basis have identified major issues such as climate change and others, and the need to have sustainable development goals, and so the impact of society that we need to have, and the growing trend for sustainable finance. And the three legs of that stool, I think today, are particularly important. And there's I would call it a unique moment of convergence, and this is something actually that we've been telling our students at CNAM in particular where we started a program in digital finance focused on fintech, and where we have courses obviously on innovation, finance, and so forth. But our latest thoughts over the last months, lead us to think that space technology in particular is a great way to leverage innovation in various venues. Now the second, if I think I still have a few minutes. The second part of my brief talk here is, I discuss space for finance, but obviously if you revert the title and, finance for space, as a former financial practitioner, I'm particularly interested myself in how, finance can help space development, and from an investor's perspective and from a financial institution perspective, what opportunities you have now with space technology as the new frontier. To the left, for those who love the Space Odyssey, this famous Kubrick's film, it's interesting, to notice actually, if you you can see already in Kubrick's film, he pointed out that he was expecting that things like space commercial travel and so forth would be done, would be facilitated by private firms. So the Pan American logo on the spaceship, there's the Hilton logo here on the this hotel, space hotel lobby and so forth. And so interesting, I think over the last 20 years, and I remember actually when I was a young engineering student, there were two really interesting subjects: artificial intelligence and space technology. But you had the sense that there were barriers to entry that were quite difficult to supersede. Nowadays, 20 years later, I mean, with artificial intelligence, we've seen that, we had the algorithms, but we didn't have the data. And now, as been said this morning, we have all the data we need to do machine learning and, all sorts of complex and, exciting things. And with space technology, I really believe that, we are at a unique crossroads where, because you still have very capital intensive, from a financial perspective, activities, such as launching and so forth, but even those, and I think the maybe in some other workshop, insurers or reinsurers, can discuss how private, actors can step in to, even insure part of the space, the space risk. But so very capital capital intensive activities on the one hand, but on the other hand, there's really, with those new, low orbit satellite constellations and so forth, lowering barriers to entry that make it especially exciting, attractive for the fintech space and, startups in general. And I know that, ESA has clearly a long list of, startups that you are supporting. So the takeaway point I want to make here is that for financial institutions and for, traditional finance actors, whether it's venture capital, private equity, or even, public markets now with, ETFs that are dedicated to, space assets, that there's there's really a huge opportunity. And I believe that it's going to, the next 10 years are going to be, super exciting for traditional financial actors to have access to space assets. So the last thing I want to mention is, obviously, since we're here with ESA, I'm quoting here a famous academic paper by Eskovitz on, the triple Elix for having a, successful innovation environment. It's industry, government, and industry, obviously. And, someone mentioned the Silicon Valley this morning, and what's been happening on the other side of the Atlantic. Obviously, in Europe, we're doing great things as well. And you know, I cannot emphasize enough the fact that this triple Elix is particularly important in the space sector as well. So just, you know, as a conclusion, and I hope I've not been too long, you know, I would say 3 takeaway points for me. There's, first of all, the convergence, again, between space technology, sustainable finance, and, you know, society, meaning by that sustainable development goals. This convergence is really unique now. Second takeaway point, I strongly believe, as a former finance practitioner, is the need to have, and it's been mentioned actually in his opening remarks, I think, by Joseph, the need to have private actors and private, you know, financiers stepping in. It's worked very well in the US, as we know, with, you know, with household names and, you know, people who sort of recycled, if I may say so, their internet money into space ventures. But, you know, I believe, and I think that's an open door, and everybody will more or less agree on that, we need to have more of the same in Europe, and there's no reason, you know, that we should consider that we're not capable of doing that. I think on the contrary. And third and last takeaway point, and this is something that, you know, I'm really convinced of, and that I openly share with our students at CNAM, is that this is a unique moment. I mean, you know, when I was, and again, when I was an engineering student going to work in space, you had to go and work for, you know, one of the big firms or the big agencies. Nowadays, you can go and work for exciting startups. And this is, you know, this is really unique. And again, this is due to, I think, this new space trend, lowering barriers to entry to have access to space technology. Thank you very much, Nick. I hope I've not been too long.
Many thanks, Alexis. And certainly I can confirm that life is quite stimulating at the center of this triple helix. It's 2001, of course, is 20 years ago. We're a little behind that schedule, but it's we're getting there. We're pretty close now to what Kubrick imagined. Thank you very much for those remarks. So we move on then to a neighboring university and business school in also in Paris, HEC. Our next speaker, Professor Thierry Foucault, is the Foundation Chair Professor of Finance there. And he's really an expert. He wrote the book on market liquidity, quite literally, market liquidity, theory, evidence, and policy. And his work is about how the financial market liquidity works, how the industry is organized around that, and then what is the effect of that on the real economy. And he's focusing on the role of information trading technologies in these financial markets. So. Thierry, if I can ask you then, in your opinion, do we need an alternative data structure in order to reach a sustainable finance? What's the role of information in this system? Thank you.
Okay, thanks a lot, Nick. Do you see my screen?
Yes.
Yeah. Okay. So what I would like to talk about is the possible applications of satellite for in finance. There are, I think, two applications. On the one hand, they can be used to generate new type of information. On the other hand, as was mentioned by the last speaker, they can be used to speed up communication. And so what I would like to do is to step back a little bit, that is, discuss why information is very important in the financial industry in general. That helps to understand the reason why there might be a demand for satellite imagery in finance. And then I will discuss also the possible implications of demand for this type of information for the quality of financial markets as a whole, their liquidity, and the informativeness of prices for longer run risk. The reason why information is so important in financial markets is easy to understand, which is asset prices are discounted value of investors' expectations. That means forecast of future cash flows. So forecasting future cash flows is very important to identify mispriced securities and so make portfolio decisions. That's the reason why, for instance, hedge funds are so interested in any type of data that can be used to form expectation of future cash flows. For this reason, there is a very vibrant market for information in the financial industry. That's part of this market is part of the financial industry. On the one hand, you have sellers like Bloomberg, Refinitiv, and so on and so forth. You have securities analysts, people who collect information and transform the information in recommendations, signals, and so on and so forth. And you have alternative data providers. I'm going to come back on that. And you have trading platforms as well. Exchanges are big data providers. In fact, nowadays, the main source of revenues for exchanges is the sale of their data. So on the other side, you have buyers, and those are mainly institutional investors, hedge funds, active asset managers, and so on and so forth, prop trading firms like high-frequency trading firms, professional forecasters, and for instance, insurance companies, as was mentioned before. So there are big changes in this market because of digitization that creates new sources of financial information, and because of progress in computing power, which means that people have access to new techniques to process a vast amount of data. That is, they can use techniques from artificial intelligence, machine learning, and the likes. And so because of that, you have the emergence of new data providers. You have many new firms that collect, alternative data. That means this type of data, satellite imagery is just one example of that. You have also social media data, point of sale data, web traffic data, and so on. And there is evidence that there is increasing interest by asset managers and securities analysts, for instance, for this type of data, because again, they can be used to forecast future cash flows, so they can be used to figure out what is the value of an asset. So for instance, for satellite imagery, you have firms like Orbital Insights or RS Metrics in the US that are selling satellite images to hedge fund managers, for instance. Satellite images like this. For instance, pictures of parking lots at stores of retailers in the US. And so with this type of information, you can forecast, for instance, what will be the sales of a particular retailer, let's say Walmart, next quarter. So that's the reason why there is so much interest by asset managers in this type of alternative data. They are increasingly, they invest increasing amounts in those data, including satellite imagery. And you have a very, that's the landscape of firms selling alternative data like satellite images, but not only geolocation data, web traffic data, sentiment data. You have many firms like that, and their number is increasing over time. So what are the questions? I think there are one very important question is if you try to think about the business potential here, or the potential for commercialization, for instance, of alternative data, some type of alternative data like satellite imagery. The first question is whether there is information in those data. And again, by information here, I mean information about future cash flows, like future earnings for firms, because this is really what is of interest for asset managers, for hedge fund managers, for instance. And preliminary findings on this question, academic findings, I mean, suggest that this is the case. There is this academic paper by those guys, which is using this type of data, and they show that, not surprisingly, when you have this type of information on a daily basis, you can forecast next quarter earnings, for instance, for a retailer like Walmart. That's not too surprising, but that's a prerequisite. Without this possibility, there is no chance that people will be interested in buying, at least asset managers will be interested in buying those data. But that's a necessary condition, but that's not sufficient. Another condition, which is that this information is not yet in prices. If, for instance, this information is redundant, you can get access to the same information in other ways. It's very likely that the information is going to be in stock prices, reflected in stock prices anyway. And so the economic value of this information is likely to be very small for asset managers. That's sort of obvious. A less obvious way in which this might be true is that as the number of people buying this type of information gets larger, you have more and more people trading on the same signal. And so the speed at which information gets impounded into prices is increasing. And so that means that the rate of decay, if you wish, of the quality of the signal, the economic decay, is higher, which means that the value of the signal is lower. So on this, there is less evidence. I must say that I'm not aware of academic papers that really try to evaluate the economic value of this type of signal for asset managers. And the interesting question, there are two interesting questions here, I think, which is from a data vendor point of view, that means that you face a trade-off. That is, if you sell your signals or your data to too many buyers, the speed at which the value of your data is going to erode is going to be higher. So what you would like to do is to limit access to your data. That's a bit surprising, but for financial information, that's a well-known principle. You would not like to sell your data to a too large number of buyers, because as you have more buyers using the data, the economic value of the data is going to be smaller. But that means that in order to make the data available from a business viewpoint, you need to create what economists call information asymmetry. You need to have a subset of people getting access to the data and another subset not getting access to the data. And as many economists know, that's not very good for liquidity. That creates, many frictions. That creates information asymmetry that are going to make transactions between parties more difficult in the market. And that's not good for the liquidity of the market. And on this, there is evidence. In fact, those guys, in this paper, they show that when this type of information becomes available to the finance industry for a retailer, the liquidity of the stock of the retailer gets smaller, and presumably because you get larger information asymmetry in the market. So what can be the use as well of alternative data for sustainable finance? So I try to think a little bit about that, and I think there is an important connection that was mentioned before by some speakers, which is in the announcement of this conference, it was mentioned that one goal of society should be to aim at balancing negative impacts of, let's say, climate change by directing financial resources into sustainable investments. By that, what is meant is investments with limited negative external effects or positive social and environmental outcomes. So the main question is, how do we do that? What does it take to direct financial resources into sustainable investment? And for this, as was mentioned by some speakers in the previous session, you need asset prices to incorporate information about the future. For instance, in the case of climate change, we would like asset prices to reflect information about, let's say, physical cost of climate risk, like for instance, damages due to hurricanes or disruptions in supply chains. But you would like also asset prices to reflect transition costs, like for instance, costs associated with change in regulatory policies for firms. So that's a very, very important function of capital markets, as is well known by economists. So I took this citation from a textbook by Jim Fama in 1976, where he writes that if the capital market is to function smoothly in allocating resources, so that's really what this is about here, directing financial resources to where we would like the resources to be allocated, prices of securities must be good indicators of value. So I think the question here is whether alternative data, and for instance, satellite imagery, are useful for that. Are they going to help to direct, to make prices, stock prices, for instance, better indicators of the value of investments that firms undertake, for instance, to mitigate their exposure to climate risk. And here I must say I'm not completely sure. I'm not completely sure because the big question is what is the horizon at which alternative data are useful? If you take this type of information, it's clear that this information is useful to predict next quarter earnings of Walmart, but it's probably not very useful to predict the cash flows of Walmart in 5 years from now. So I think that's a question of which is really, really important, which is what is the horizon at which alternative data in general and satellite imagery in particular provide information. There is evidence that alternative data provide information over the short run, let's say over an horizon of at most 1 year, I'm not aware of academic evidence showing that it provides evidence at a horizon longer than that. And in fact, my own work on this question suggests that this might not be the case. In fact, I have a paper, a recent working paper with Laurent Frédard with the University of Lugano and Olivier Dessin with the team SEAD, in which we study empirically the effect of alternative data, in this case social media data, on the quality of earnings forecast by securities analysts at various horizons, ranging from 1 to 5 years. So securities analysts do rely to some extent on alternative data, increasingly so. And so what we do is that we use a large sample of US public firms and analyze forecasts for those firms. And what we find is that as the amount of alternative data from social media gets larger, analyst forecasts of short-term earnings gets better in quality. They make smaller forecasting error. But the quality of their forecast for the long run gets worse. And our interpretation, this is the reason is that they tend to reallocate their efforts in information production. Because this source of data, alternative data, is cheaper, they tend to invest more in this type of data, which is good, for forecasting the short term, but not so good for forecasting the long term. And I think it would be worth, asking the same question for alternative data in general. For instance, again, satellite imaging. Last, as was mentioned by the last speaker, there are discussions about using satellites to for increasing the speed of information transmission between various financial centers like Chicago and London, for instance, Wall Street and the City, or Chicago and New York. This is very, very important for some trading firms, like high-frequency trading firms, for instance. Their business model relies very much on getting super fast access to information. Very often, they are going to take advantage of fleeting price discrepancies between two market centers like Chicago and New York, for instance, for the same type of asset. So far, the technologies that are used for that to speed up transmission of information between financial centers, these are fiber optic cables or microwave towers. This is what people use to speed up transmission of information between Chicago and New York. And of course, you could probably get even faster access to information, let's say about transactions in Chicago to trade in London via satellite. Whether this is a good thing, again, this is sustainable finance in a sense, is not clear at all. There have been big debates about the effect of high-frequency trading on market quality, for instance, liquidity. What people have found is that there are cost and benefit. Many high-frequency trading firms are market makers, and so they tend to improve the liquidity of the market. That's an activity which is good for liquidity. But some trading firms are just, trading in advance of information at the expense of other market participants. In the sense, they create information asymmetries, and that's not good for market quality. There is a very interesting recent paper published in the Journal of Finance by those two guys, who show that the introduction of microwave transmission of information between Chicago and New York is essentially, as of course, be extremely useful for high-frequency traders. They make more profit out of that, but bad for the liquidity of the market. Okay, so that's it. And I think I will leave the floor there.
Many thanks for that. Let's pass on now quickly to our the next speaker from the world of academia, also Professor Ben Caldecott. So he's the director of the Oxford Sustainable Finance Programme and Lombard Odier Associate Professor of Sustainable Finance at the University of Oxford. Also director of the UK Centre for Greening Finance and Investment. He's advising the UK Cabinet Office at the heart of the UK government on COP26 strategy. He's co-chairs the Global Research Alliance for Sustainable Finance and Investment, the Sustainable Finance theme at the Alan Turing Institute, and I'm sure he has ample free time. And prior to this, he was also vice president of the Climate Change Capital Investment Bank and has worked as research director for environment and energy at the Policy Exchange think tank. So he comes from both that consultancy and practice background. Ben, can I ask you how you see the alignment now between sustainability and finance? Both of these are in transition, disrupted on both sides. Have we properly taken into account the climate change matter and integrated that into the financial transition?
Great, thanks, Nick, and thank you for that very kind introduction. So like the other speakers, I'm going to give you a short presentation and hopefully answer that question for you. If that's okay, can you see everything?
Yes, we see that, thank you.
Good, all right. So sorry, getting used to this to WebEx. Great. So what I wanted to do first was just to tell you a tiny bit about this new UK Centre for Greening Finance and Investment that began operations on the 1st of April, and then tell you a bit about an initiative and a project that sits within the new centre that sort of folded into the centre, began a few years ago. Focused on spatial finance and the creation of asset level data sets, and I'll explain why I think that's really important, and hopefully that will help to answer the question that you asked, Nick. So CGFI was announced in February. We began operations on the 1st of April. It's a consortium led by the University of Oxford with 4 other UK research universities, Imperial College London, Bristol, Leeds and Reading, all of whom have climate and environmental expertise as well as finance expertise, together with the Alan Turing Institute, which is the UK National Centre for Data Science and Artificial Intelligence, and the Satellite Applications Catapult, which I know works very closely with ESA, and the Science Technologies Facilities Council, which provides data and analytics infrastructure for UK researchers. And the mission is very ambitious, which is that we want financial institutions around the world ultimately to be able to access and use consistent, timely and appropriate climate and environmental data and analytics for any point on planet Earth, historically, in the present and projected into the future, for all the major sectors of the global economy and for the complete spectrum of material climate and environmental factors. Now, that is a big mission. We have some funding from UKRI to begin moving in that direction. And of course, doing so, which is, I think, a shared objective of many people across this workshop, and I've been speaking, and I look forward to working with them, hopefully, in different ways, will enhance the solvency of individual financial institutions. It will improve the resilience of the global financial system. It will ensure the efficient pricing and reallocation of capital. And critically, as the last speaker was suggesting, will help to shift capital away from assets that are exposed to these risks and assets that create these negative externalities to those that are less exposed and more resilient, and hopefully can help solve the problem. Now, there are a whole bunch of different things that we need to do to solve these data and analytics questions and gaps and challenges. But obviously, a really core part of this is the greater use of Earth observation, and of course our ability to process that information. And spatial finance is really part of that. So one of the things that we launched a few years ago at Oxford with others is the Spatial Finance Initiative, and this is part of the new centre. And spatial finance, which is a phrase that we coined at Oxford, very glad to see people using it a lot now, is the integration of geospatial data and analytics into financial theory and practice. And this is a really big part of one of the key strands within the new centre. And the journey we've taken at Oxford really started, I guess, in 2015-16, when we were starting to do lots of sectoral analysis on stranded asset risk exposures. And it just became very clear that we needed much better geospatial data to do that. The use cases that, there's so many use cases, and the use cases that we're probably more excited about are less of the ones that were mentioned in the previous talk. So less about hedge funds, less about getting economic data before official data is produced, for example, and more about asset owners, asset management, banking, institutions that don't necessarily need data to be super up to date. You know, they don't need updated data day to day or week to week or month to month. It's more like every year. And the use cases are the sort of the standard use cases in finance. The most of investment activity, for example, long only equity strategies, rather than some of the more exciting, more novel stuff. So how, as a long only equity investor, could you use geospatial data, for example? And that leads you down a particular path that's really important, and that's the one I'm going to spend most of the time talking about. So a lot of people have covered things I wanted to say. One of the problems of coming near the end, but obviously explosion of Earth observation capabilities, our ability to process this information. I'm sure these slides will be circulated afterwards, so I'm not going to spend too much time on them. You've heard all this before, but the key thing, going back to what I was saying about these use cases that we're interested in, is that you really need asset level data, data on assets in the real economy, their characteristics, and critically for finance, who owns these assets. And if you don't have that information, you can't link that back up to companies, you can't link that into portfolios, and you can't do the analysis that you need to do. So you need to be able to have asset level data with that ownership information. You also need enough information about each asset to be able to understand how it might be exposed or vulnerable to certain risks, or how it might be making pollution worse in a particular area or globally through greenhouse gas emissions. That's very important. And also for this to be really useful for that, the sort of the big mainstream investors and big banks, you need coverage. You know, it's not enough to have really good asset level data for one country or one region. Big institutions are going to have exposures around the world, and so you need asset level data sets that are consistent on a global basis, so you can do comparisons and meet the needs of those users. And the state of asset level data is not great. So when we're talking about consistent global asset level data sets with ownership information, it's really patchy. So there's some proprietary data sets. A lot of those aren't using anything particularly snazzy. That's all kind of been manually going through reports and manually creating and maintaining these data sets. The incentive often for owners of those data sets will be to sweat that asset. You have some public data sets, the most notable of which, and this is a sort of model for some of the work that we're doing, and we contribute to these data sets as well, is around power generation. So we actually have pretty good asset level data sets for the global power sector. There are always issues which we can come back to, but that is the sort of the area where we have the best data. But for everything else, you can see in this chart, we don't have a lot of data availability. Now you might be able to bring together different proprietary and public data sets to come up with a solution possibly, but with different formats, different licensing rules, that becomes very difficult. So if you're an investor or a bank and you're like, okay, well, I've got sectoral exposure and and global exposure to some of these sectors, how do I piece all this information together? The answer is it's really very difficult, and I don't think even the biggest institutions would be able to do this very easily, and so that's a bit of a problem. And I think the other thing, and I think Marianne said this also earlier on, and it's good to see her talk, is having this fundamental asset level data allows you to do and create all sorts of things, right? You can build, once you know where the assets are in a sector, you can build on all sorts of different overlays, you can create all sorts of different additional value added analysis. So we're kind of seeing this as resolving this problem of missing asset level data globally as it really is a public goods enterprise, an endeavor that we should coordinate. The solution to this is not lots of little proprietary data sets. The solution to this is a coordinated effort to create consistent global asset level data sets for every sector on planet Earth, and for those to be available to everyone, and for people to trust them, and be able to work with them and understand how they can work, and then to build products and services on the back of them. And this is why we think this is really important, actually, for unleashing some of the commercialization opportunities in this space. So what we're trying to do through something called the Geo Asset Project is to create these asset level data sets. And at the moment, we are very focused on two sectors of the global economy, cement and iron and steel, which where there aren't those data sets, and they're very significant contributors to greenhouse gases. I'm going to say more about those sectors quickly in a sec, but just to underline the point that this work should be coordinated and seen as a global public goods endeavor. You know, we've been arguing that this is sort of analogous to the Human Genome Project. So 21 years ago, thereabouts, you know, the G7 basically went, look, we're gonna sequence the human genome, and there was a coordinated research effort through that process. The process itself generated innovation. Sequencing the human genome enabled innovation, and we can do something like this for asset level data, sequencing the real economy essentially systematically. And we don't think it requires nearly anything like the amount of resource that's been required for sequencing the human genome, in part because a lot of the infrastructure, as ESA being a testament to this, already exists, right? There's been a huge amount of money from governments into the Earth observation infrastructure required to do this, as well as private investment. It's really a kind of a question of processing that systematically and creating the machine learning algorithms to do this, enhancing them and keeping them up to date, and making sure and dealing with that ownership issue, which has its own challenges. And given just the number of use cases we unlock, we're advocates for this to be something that starts very soon. And 2021 is a good moment to do this with COP26, for example. A lot of these cases can, of course, be climate related, and for a range of organizations to do this. So I guess this is sort of my opportunity to the audience to go, look, this is a call to action, a call to arms. Let's make this happen, because it will help all of the things that we want to do across the different presentations we've all seen. Now on iron and steel and cement. So cement's about 6% of global CO2 emissions, iron and steel about 7%. Existing problems with existing data sets, lack of coverage and so on. So through the Geo Asset Project, we've received funding from the Children's Investment Fund Foundation to create these asset level data sets for these sectors, and we've been using satellite imagery and machine learning algorithms to do this. And again, with time constraints, I'm not going to go through all of this, but I'll show you some nice pictures. On ownership, this is kind of tracking changes in ownership is really important for this to work properly, and I think developments in natural language processing can speed that up, and that's something we've been experimenting with, and this links back to some of the other presentations, including the one with rep risk. So I think you should, although in terms of its impact on finance, I actually think that the geospatial is going to end up being much more impactful for the future of financial analysis than, say, sentiment analysis. I do think that they can be complementary and support each other. So this is an area where they would do that. And ownership, but this is all us characterizing the technologies in the sector and observing change, and then creating data sets. So these are going to be the cement data set will be published first pretty soon in the coming months. But this allows us, you can then start doing all sorts of analysis and aggregate that up to any level. So you can do stuff at a country level, obviously, if you know where assets are in a country. That's all very straightforward. One area that's super important is what we call committed emissions or carbon lock-in. If you've got asset level information, you can then look at the implied carbon lock-in, the implied committed emissions of all the assets and each asset, and to see whether they're compatible with different carbon budgets. So you can do this for the power sector because we have asset level data sets. You can't do this for cement and iron and steel. So that's one of the things, an early bit of work using the data sets. And this is one approach to do that. I'm not going to run through all of this, but basically you can determine which assets are compatible or incompatible with different carbon budgets. And you can look at which countries have lots of assets and which that are incompatible, and you can look at individual companies, and then you can look at portfolios, and lots of other things, and physical risk, of course, as well. So that's just a bit of a canter through some of the institutions that exist that we're setting up to help sort of accelerate work in this space. And I'm really keen that we work together. Please do email me if you want to get involved in CGFI. It's funded by the UK, but is a global initiative, and the data sets are global, and we're working with lots of international partners. And then specifically this GeoAsset project, and we're keen to scale up that work and begin projects in other sectors with other actors, starting, of course, with the most polluting. I think it makes sense to start there. I'm going to stop now and looking forward to some discussion.
Well, thank you, Ben. I'm sorry to say we're running a little late on our session, which is going to squeeze our time for questions, but so it goes. Let me introduce them without any delay our last speaker to close this session too. This is Frédéric Dalibard. Now, Frédéric is an expert in blockchain and is the global blockchain coordinator for Natixis in Paris. And prior to that, quite recently, he was the head of digital and innovation for Natixis in the corporate investment banking area. So Frédéric expresses a personal taste for change, action, and ambitious projects. I think this is a great crescendo for us to complete our session on. I pass directly to you, Frédéric.
Thank you, Nick. Can you hear me?
Yes.
Yes, cool. Well, thank you very much for having me on the panel today. I'm conscious that we are running late on the panel, so I'll try to go straight to the point. First of all, a quick introduction about Natixis, because all of you maybe don't know Natixis. Natixis is a subsidiary of the second biggest retail banking group in France, the BBC Group. And the main activities of Natixis are corporate and investment banking, asset management and wealth management, insurance activities, life and non-life, and payment services. For the three first ones, you'll see that the satellite data can have implications, and that's what I'm going to discuss. Of course, I'm not a policymaker, not a regulator, nor a finance scholar. So the perspective I'm going to try to give you today is the one of a banking practitioner, with very pragmatic examples of what we are looking at when we think about spatial data and our activities, and how they can help us in our activities. I hope my remarks will resonate with what has been said previously, including in particular the remarks of Professor Thierry Foucault. I've been involved with innovation, as Nick was mentioning, at Natixis since 2015, and I've witnessed the acceleration in the use of data and digital tools in general to support our businesses. All of this has been made possible by an extended access to various and rich data sources that we didn't have access to before, the access of tremendous amount of storage capabilities to house and store these data and be able to access them conveniently, and of course, cheaper access to massive computation capabilities. The main activities of Natixis touch upon providing financing and make investments for our clients and internally for our insurance arm. As I will try to show you now in the rest of my presentation, we can clearly have an interest in leveraging data from satellites to secure our transactions and or monitor our investments. So we can see a lot of potential, although I have to note, and this is my understanding at this stage, that we are only at the beginning of the development of these applications, and they are not widely used yet, at least as I can tell. In that respect, I think this is important to note that I believe that there are big opportunities to be seized in that space for ESA and for its partners, sometimes fintechs, and it was mentioned before that even small actors can access these data and provide meaningful solutions for actors like us. The potential of the use of satellite data, in my view, exists in at least three areas for Natixis. First area in the commodity financing space, be it energy commodities, agricultural commodities, and even ore and mining. It can offer the possibility of monitoring the inventories through satellite imagery, sometimes in combination with other technologies like ground-based IoT. And we spoke also about the capability of tracking cargoes. And when we speak about imagery, monitoring extraction fields, for example, could be of value. And if I speak about why we would be looking at this for commodity financing in particular, is that the way we have been conducting our business so far has been to send surveyors on the field on an infrequent basis. This is costly, does not provide real-time data, etc. And satellite imagery can leapfrog us into real-time monitoring and alerting. And when I say monitoring and alerting, you have to know that the commodity financing space is often subject to fraud and theft, where banks are financing some collateral which doesn't exist any longer, and which has been stolen from its storage location. So we could alleviate these risks using space data. Of course, one of the trivial use cases, as I was mentioning before a few minutes ago, relates to geolocation of cargoes and containers, so that we can track on real time the goods which are being transported from one point to the next, and that we are financing. Second area of interest, financing projects. So we are a big financer of infrastructure projects, and especially in the field of sustainable energy or renewable energies. And at various stages of the project, satellite data can have an interest. First, when assessing the potential and the viability of a project, satellite data can help us assess the value or the long-term value of the project, and if it makes sense to actually finance that project. Can relate to real estate, for example, to determine if a location is proper, an implantation location is proper for that particular real estate or piece of real estate. Commodities extraction, or when we are looking at renewable energy, we can assess the potential of the location for the project, if that's wind exposure, sun exposure, etc. Then, during the building phase of the project, we can monitor the good progress made in the deployment of the project by comparing satellite images of the construction site from time to time. And it's important, well, this data is important because sometimes financing tranches are deployed only after certain milestones are met in the building of and deployment of the project. Finally, during the exploitation period, and if KPIs are in place to monitor the production that is extracted from the project, space data along with other data can be used to confirm the relevance of these KPIs, of the downtime sometimes of some production facilities, and to monitor in general the good performance of the project on almost a real-time basis, which has not been the case before. Finally, third area, and I touched upon it when I spoke about projects related to sustainable energy, ESG related financing and investments. As you might not know, Natixis is one of the first banks to have put in place an indicator, which is called the green weighting factor, which assesses the ESG nature of its CIB, so corporate investment banking activities, in order to incentivize business lines to favor ESG conscious financing. For the moment, I think the use of satellite data to compute this indicator is limited. And it resonates with what Marianne from the previous panel was hinting at when she was saying that in such approaches, banks are often using not very granular data, average data and business flows. However, I believe that the future of these type of indicators will be to embed more and more satellite data in order to grasp more granular data points in our approach. Also, there is a wide range of ESG-related investment offerings being designed, in particular at the level of our Mirova asset manager, which is at the forefront of ESG-conscious finance. For many of them, it is going to be more and more important as time goes to be able to monitor and measure the ESG impact of these investments over time. In that respect, space data is a good source of information to be able to confirm that the investments we made and the projects we invested in for our clients meet the criteria which have been set in terms of CO2 emission limitation, preservation of wildlife diversity, forest preservation, and so on. So I think I'm reaching the time limit. As a conclusion, I hope I was able to convey the importance of satellite data to improve the relevance of what banks are doing for their clients, either in terms of performance of their projects, the limitation of risks in financings and investments, or regarding the impact of ESG investments. Thank you very much.
Thank you very much for that, Frederick, and thank you for keeping to your time. May I also extend my thanks then across all of the speakers who participated in this session over the last hour and a half. It has been fascinating. We've touched so many agendas. We are really quite behind time now, so I will not delay anymore. I encourage you to stay online and now to hear the third session of today's webinar, which deals with what ESA is doing in this space. And to moderate that session, I hand over to my colleague, Giorgio Solari from the Navigation Directorate. So to you, Giorgio.